Okay. We are just letting people in now, so we'll start in. Okay, hello and good afternoon, everyone. Welcome to the second day of the webinar, Measuring Portfolio Alignment to Climate Scenarios and Climate Stress Testing. So for everyone's information, this is the first training of the JAST series. For the year 2022, JC3 Subcommittee 4 has planned out and will be hosting a series of webinars under different themes, starting with incorporating ESG into risk management. Before we begin, I would like to remind everyone on a few house rules. Firstly, throughout the webinar, if you have any questions, please feel free to use the Q&A box at the bottom of the screen. The speakers will attend to the questions as we go along. There is also a dedicated Q&A session at the very end, where speakers will be answering your questions live. The questions need not be limited to the sessions today. If you have any burning or answered questions from yesterday, please feel free to post them in the Q&A box. Secondly, please also take note that the session today will be recorded and the recordings will be made available later on the JC3 platform. Lastly, I would like to remind you that there will be a survey right after the training today. So if we could have a few minutes of your time, your response would be highly appreciated. So before I hand over to our speakers from 2DI to start today's session, we'll be posting. So if we can have the poll up, please, for a couple of minutes, and we can let the participants answer the poll or why. Okay, the poll is up, so if everybody's feedback on it, for a while, it will be great. Hello, so now can we have the answer to the poll up, please? Thank you. Okay, so for the first questions, we asked how are the participants finding the webinar so far? So a good majority of you are answering useful, so that's very good to hear. And people also are taking are the reception to the tools that I introduced yesterday have been very positive. So that is very helpful as well. And as expected, most of the institutions here find the power and energy sector will be most relevant to be applied to their organization. And lastly, so from all the use cases that we posted between disclosure, strategy, target setting, and risk management, most participants find that risk management will be most helpful. And the use cases of PACTA will be covered today by the speakers. So if you are interested to learn more, please stay tuned. So without further ado, I would like to pass over to our speaker for today, George Harris, who is the product lead of PACTA for banks at 2DI. George.
Hi, good afternoon, everyone, and thank you very much for joining our presentation today. I will just get up our slides for the day. And can someone quickly confirm that the slides are viewing, you can see them?
Yes.
Thank you, Daisy. Great, so thank you very much everyone for tuning in again today, and thanks for taking the time to answer that poll very quickly. So today we're going to be, well, I'll walk through the agenda in a second. Yeah, so today we'll be going through a quick case study. So yesterday we looked at the methodology of PACTA, how we can run PACTA for the different institutions, for investors, and then also for banks. We then had some explanation about the stress testing module, which is kind of an auxiliary module to the alignment part of PACTA. So kind of focusing on that risk management use case. And again, useful to see that that was the most selected option in the poll just now. So today we're going to be looking at a brief case study of a sample of corporate lending loan books that we've been running PACTA on, to see what these results look like in a real context. Off the back of that, we'll then go into some recommendations. So some recommendations for Malaysian banks wanting to use PACTA in the future. So what sort of things should you look out for and how should you run it? We'll then also look at how we can improve PACTA. So these are kind of looking back at 2DII and the collective group working on PACTA as to how we can improve it in the future. And then finally, we'll have recommendations on how we action these PACTA results. So what I mean by this is the sort of use cases, and again, risk management being the kind of most popular one here, but also looking at target setting, disclosure and reporting, and others. So that would be the first section, looking at the case study and then the recommendations. And then we'll also introduce kind of what else can we do after PACTA. So what are some additional tools and research that we at 2DII have been conducting? We'll just be giving you a little flavor of this. So I have colleagues from our Evidence for Impact team on the line now that will be presenting this. I'll present a quick look at our 1 in 1,000 work, so it's more long-term risk. We also have Constanza from our retail program. So the retail piece is more geared towards asset managers and the investment side, and those with retail investments. And then finally, we'll conclude with a big Q&A session. So as Fatin points out at the beginning, if you have any questions, please drop them in the Q&A box. We'll try to answer them as we go through, and then we'll leave plenty of time to answer them out loud at the end as well. And again, if you have questions from yesterday that we didn't quite get round to, please feel free to drop them in the Q&A again. So with that, I will hand over to my colleague Daisy, who's going to give you a quick recap of the PACTA methodology and then run into some of these results we found based off this group of corporate loan books that we were analyzing. Thanks, Daisy.
Great. Thanks a lot, George, and good afternoon, good morning, everyone. Thank you again for being here to this second day of the webinar. So before we dive into the first section of today's presentation, which will show the results of the application of the PACTA methodology to a sample of corporate lending loan books, as George mentioned, We will start with a very short recap of what PACTA does, of how the PACTA methodology works. So for those of you who attended yesterday's webinar, this first slide will look very familiar to you, but for those of you who did not attend, what we aim to show here is like a very high level summary of how PACTA works. So if we start, basically what PACTA is the Paris Agreement Capital Transition Assessment, and is a climate scenario analysis methodology. The PACTA methodology allows like financial institutions to measure the alignment of financial portfolios to various climate scenarios. So what we see here in this first part of the slide is that one of the core principles of the methodology is that the alignment of the financial portfolios is measured based on the production values of physical assets in the real economy. And this we will do across various sectors, which you see here at the bottom right of the slide. The PACTA methodology covers mainly the oil and gas, coal, automotive, power, cement, steel, and the most recently added sector, aviation. We are still working on including shipping, but these are considered by PACTA as the most climate relevant sector. So we work with a data set provided by our main partner and data provider, Asset Resolution, which will tell us, for example, where in the world is a steel plant located, where in the world is a power energy plant located, how much they are producing, which technology they are using to produce, and as well as information on who owns them, and also information like forward looking up to 5 years of production. So the production values coming from these data sets, coming from these physical assets, what we do first is we link them, in the case of the banks, to the corporate lending portfolio. And we do this by using a portfolio weighted approach, which means that the production of a client is allocated to the portfolio based on the size of the exposure to that client. So these like specific principal accounts of the methodology were briefly explained yesterday, and you will also find in the website, we can share later the links for the methodology documents, in which you will find very detailed explanations of these principles. So after we got the assets in the real economy attributed to the portfolio, what we do is we measure the alignment to the portfolios to the different climate scenarios. Mainly, the PACTA methodology uses the scenarios from the International Energy Agency. I will say some few words about the scenarios in the next few slides. So after we complete these first two parts, we finally show the alignment using 3 different metrics, which is the ones that we show here. The technology mix, which shows basically the sector breakup by technology. We also show alignment through the volume trajectory metric, which is forward looking. So we see over the next 5 years how the companies are building up capacities based on their capital expenditure plans. And for those sectors for which we don't have technology pathways so very well defined, say cement and steel and aviation sectors, we convert the production values to intensity, and we show the results of the alignment through an emission intensity metric. So this is how in very high level terms, the PACTA methodology works. We will see the results of the application of this methodology to the corporate lending portfolios of a sample of banks. As I already briefly mentioned, so PACTA currently covers 7 of the most climate critical sectors, spanning energy, transport, and industry, and only the most climate relevant segment of the value chain. So given that we do that, given that this is considered the most critical segment of the value chain where the alignment efforts are most needed. So if we focus, for example, on power generation units, what PACTA does is that it assumes that if this specific segment falls in line, then the rest of the value chain also will fall in line. For the specific case study that we cover here today, we will only have 3 sectors considered, which are oil and gas, power, and automotive. So if we go to the next slide, as already mentioned, PACTA measures the alignment of climate relevant sectors in a portfolio with different climate scenarios. In specific, we use the scenarios from the International Energy Agency, but there are different scenario providers. So we see here in the table to the on the right some examples of it. And these scenarios, what do is that they provide some insights and give not predictions, but more specifically projections about how the future should look like in terms of decarbonization pathways. So these scenarios will tell us is it will basically give us like the pathways that are needed to achieve certain levels of global temperature. There are currently different scenario providers, such as the one that PACTA uses mainly, which is the International Energy Agency. And these scenarios basically have different sets of scenarios which vary on climate ambition. So some of them are related to business as usual scenarios. Some others are related to global temperature increase of 2 degrees. Some others, like most recent ones, are most related to net zero emissions. So these are like very different climate ambitions scenarios, which also vary on the model assumptions that are used to build them. Also, they vary on the time frame. Some of them are giving us projections until 2050. Others give projections until 2060, for example. Another characteristic that is also different from scenario to scenario is the sectors that they cover. So some of the providers cover only power and oil and gas, for example. Some others providers covers automotive. And then the last characteristic that is also different between the scenarios is the regionality. So some of them cover like the global scenarios. Some others have more granularity and also like can even cover at the regional or like even country national level scenarios. The table here, what I mentioned is that it shows the different types of scenario that PACTA can use. But for this specific case study that we are going to present today, the scenarios that are used are basically benchmarking against 2 regions, global and Southeast Asia. So if we start now with the results, if we go to next slides, we will start with the results of the application of PACTA, again, to a sample of corporate lending loan books. And here we start with the oil and gas sector. We will see here in these first 2 slides that we will see the results of the production trajectory of oil and gas production. So as I mentioned at the beginning, PACTA uses 3 different kinds of metrics: the technology mix, the volume trajectory, and the emission intensity. Here, what we see is the production trajectory of the first sectors that we are analyzing. So here we see the specific example for the production trajectory of oil for the aggregation of the portfolios that we are using in the case study, benchmarked against global targets in this case. Here we start with global, given that the oil and gas sector only is mainly covered by the scenarios in a global perspective. So that's why we choose to show here against global targets. So what we see here in this chart is you will see the different scenarios depicted by the different colors in the charts. For example, here you can see the SDS scenario, which is the sustainable development scenario, and is associated with 1.75 degrees to 2 degrees Celsius global temperature. So what we see is that this specific scenario, the SDS, is projecting that the oil production should decline in the next 5 years. So this is what we see in the green line. We also see another scenario, which is the SPS, which is states for stated policy scenario, which is associated to a global warming of 2 to 2.7 degrees Celsius. So here we see that the SPS scenario prescribes oil extraction to remain relatively constant. Again, at the global level, we are comparing to global targets, and this is for the next 5 years. While what we see also with the SDS is that it requires a slight decrease, as we see by the green line. What we are interested here in seeing is the projected line, which is the continuous black line there, which is called projected global. And what we see is that the aggregation of the portfolios that we use for this case study shows a small increase in extraction of oil for the next 2 years. And then before we see a gradual decrease through 2020 to 2025. So what we see is that even though the oil production is expected to decrease as is depicted by the projected global, it is still not aligned with what the SDS scenario is telling us. If we see also the dotted dashed line, which depicts the corporate economy, this is the aggregation of all oil companies at a global level. What we see is that the global oil corporate economy shows a steady increase in the rate of production throughout the 5 years of analysis, which is also not aligned with what an SDS scenario is projecting. So if we continue with the production trajectory of gas production, which is in the next slide, what we see here is a slightly different story. So the SPS and the SDS scenarios, so the green and the yellow lines are telling us that the gas extraction will remain relatively constant during the 5 years. And what we see from the aggregated portfolios that we are analyzing is that it shows a steep increase in the rate of production from 2023 to 2025. So with these results, we say again that the production of the volume trajectory of the gas production is leading to a significant misalignment with what the SDS scenario is telling us. And if we see finally here in this chart, the corporate economy, this is not showing any changes during the next 5 years. So we can basically say that is pretty close to what the SDS scenario is telling us. So these were the results for the oil and gas sector. If we go with the results of the power sector, here we can also find the other metric that PACTA uses to show alignment, which is the technology mix. In this case, we are benchmarking against the Southeast Asia region targets. This is a different way of seeing the results. Here we can see like how the portfolio, how the exposure of the portfolio looks like in 2020, which is the first line that you see there, which is called aggregated portfolios. And then we can compare in the same year to how the corporate economy looks like. So the corporate economy, again, is like the aggregation, in this case, of the Southeast Asia companies on the power sector. And if we compare those two first lines, we can see that the portfolio has a higher exposure to renewables, which is the green part of it. One specific thing that is important to remember is that PACTA considers two kinds of technologies used to produce power, which are low carbon and high carbon. Between the low carbon technologies, PACTA considers the renewables capacity, hydro capacity, and nuclear. And among the high carbon technologies, those are considered as gas, oil, and coal capacity. So here we can see like the division, like the division of the exposure of the portfolios between these different technologies. And we can compare again like how the aggregated portfolio looks like against the corporate economy benchmark in 2020. The technology mix here is telling us only one part of the story. So here we see in 2020 what is happening. We can compare to what the scenario tells us of how the portfolio should look like in 2025 in order to be aligned with an SDS scenario, which is the last part of the chart that we see there. So we see that the SDS scenario is requiring the portfolio to increase the share of renewables. So here I follow the example of renewables, which is maybe the most important to see from this chart. So we see that the SDS scenario is requiring like that the share of this technology is should increase to more than 25% of the aggregated portfolio. If we see, for example, another technology, the exposure to coal-fired power generation is lower. The exposure of the aggregated portfolio is lower compared to the corporate economy, but should decrease to be aligned with an SDS scenario. So this is what is telling us also the last line. The technology exposure to other technologies such as hydro, oil, and gas-fired power generation is still relatively aligned according to what we see from the different shares of the bars there. So this is only one part of the story. PACTA considers that this can only tell us like what is happening in 2020 and what is happening in 2025, but we still need to see like how or what should happen between these 2 years on the production values of the companies in order to be aligned with different scenarios. So that's why we still require, and it's still important to see to look at the production trajectory, which is what we see in the next slides. So if we start again with coal capacity, here what we see is that the results are benchmarked against both global targets on the left and Southeast Asia targets on the right. So we start at the global level. We see again both scenarios, the SDS and the SPS, which both require a decrease in coal-fired power generation. So this is what we see on the trend line going downwards. If we compare to the aggregated portfolio, which is again the continuous black line, which is called projected, we see that the aggregated portfolio is misaligned because it is actually increasing the production of coal capacity. More or less the same is happening with the corporate economy, which is also doing like this small increase if we compare to global targets. In the Southeast Asia side, like we see that the scenarios allow for a slight increase in coal-fired power generation, as we can see depicted by the SDS and the SPS lines, which are like following a slight increase during the next 5 years. So this is telling us that in this context, the sample banks are considered to be aligned with an SDS scenario. And again, the corporate economy in this case is significantly misaligned, given that it is following an upward trend, according to what we see in the charts. If we go on with the oil capacity, on the next slide, we see that both global and Southeast Asia targets project the same. Both SDS and SPS scenarios show a decrease in production of oil. And we see the aggregated portfolios are also misaligned with what the scenarios project, given that there is this increase in oil capacity during the first year and then this subsequent steady level on production. If we go on to gas-fired power generation, which is in the next slide, we see again like kind of a similar story to what we see for coal. So at the global level, the aggregated production trend is misaligned with both scenarios, but it still performs slightly better than the corporate economy. If we compare to the Southeast Asia region, on the contrary, banks are considered to be aligned with the SDS scenario. So the Southeast Asia corporate economy in this case shows a rapid increase, suggesting a misalignment with both SDS and SPS scenarios. So with these charts, we can actually see like the importance of evaluating the results of PACTA against different region and different contexts, depending, of course, on the portfolios. If we continue then with the low carbon technologies, again, for the power sector, here we find the production trajectory of hydro capacity. So we see on the first part that the aggregated portfolio is aligned with the required build out in hydro at the global level, as is prescribed by the SDS scenario. However, what we see in the bottom part is that at the Southeast Asia region, it is only aligned with the SPS scenario. We see for the low carbon technologies, the respective corporate economies plotted in a different chart for methodological reasons. And what we see here is that both aggregation of companies at the global and at the Southeast Asia region are aligned with what is required for the targets. If we go on to the next slides, in terms of renewables capacity, what we see that is depicted by the projected lines, the projected global and also the projected Southeast Asia lines, we see that the flat line for the aggregation of the portfolios implies that the banks still have exposure to renewables, but the production coming from those exposure is constant over the next 5 years. Therefore, is misaligned with what both the SDAs and the SPS scenario is telling us, because according to the scenarios, the production of renewable capacity is projected to increase in the next 5 years. The respective corporate economies, again, for both global and Southeast Asia, are misaligned with both of the scenarios. And if we go to the interpretation of the last sector that is considered in the case study, which is the automotive sector, we see that in 2020, the greater exposure of the portfolio is to internal combustion engine vehicles. So this is what we see in the first line of the bars. And if we compare to the corporate economy, we find that the exposure to ICE vehicles is greater than the aggregation of the corporate economy, again, at the global level. For this specific sector, we are comparing against a net zero emissions scenario, which requires the production of ICE vehicles to substantially decrease in 2025, as we can see in the last bar of the chart. And the net zero emission scenario also is projecting that the share of electric vehicles needs to increase. And if we compare to what we see today in the aggregated portfolio, we see that there is a significant misalignment there. If we go on and have a closer look at what the volume trajectory of the ICE vehicles look like, we find here that neither the aggregated portfolio nor the corporate economy are following the trend of what the scenario tells us, given that both are following this upward trend. If we go to see to the next slide, the other three types of vehicles that are considered. So the net zero projections tell us that the production of those types of vehicles need to increase in the next 5 years, as it is depicted by the three plots here. But what we find in the case study is that the aggregation of the portfolios that we are analyzing are not following this trend. So therefore, we can say that it is misaligned. There is an important caveat to do here, is that these specific results might indeed show us that the sample of portfolios that we use have exposure to these types of car manufacturers, but this might not be captured by the PACTA methodology. So it is always important to do the caveats about the data that we are using, and also because it will help us at the end to interpret the results correctly. So these are the main results that we found from the application of the methodology of the PACTA methodology to the sample of corporate lending loan books. So I will now give the floor to George back to talk about maybe some key takeaways and the recommendations from what we found in this study.
Great, thank you very much, Daisy. And I hope that was useful to everyone to get a quick idea as to what you can achieve with this in terms of your results. I think a few quick takeaways are that noticeably there's a fairly significant amount of misalignment, but I think it's important to note that this also represents a big opportunity, particularly when we looked at the renewable section and the electric vehicles and the hybrids as well. We see a relatively flat line, which means that we don't, well, a completely flat line in some cases, which means that we aren't showing an increase in the build out capacity. So we're not seeing additional lines of electric vehicles or renewable energies getting put onto the grid or onto the car manufacturing lines. So this is what's important in terms of the transition to a low carbon economy, is we don't only need exposure to these sectors. Exposure might help us from a de-risking point of view, but from a contributing to the transition to a low carbon economy, we actually need to see a shift in the productions. We need to see a decreasing rate of change from the high carbon ones and an increasing from the low carbon ones. And this represents a big opportunity to invest in kind of new and to steer capital towards new products, in this case, the renewables and the electric vehicles. I think also another key takeaway is the importance of this regional contextualization. So you saw that there was no nuclear energy, for example. This makes total sense as there isn't in the region. So you're not expected to build out in nuclear capacity as there isn't nuclear capacity kind of available to build out into. This would be a different picture when we look in the European context. So I think that's an important point to note as well, is to use regional benchmarks. Yes, I also like to mention, and I should have done this at the beginning, that we will be releasing a white paper documenting these findings, going into them in a bit more detail, adding a bit more interpretation, and also building out on these recommendations that I'm about to introduce now. This white paper should be coming out at the beginning of February, and it will be publicly available, so kind of watch this space and you can dive into this in a bit more detail. So with that, I will quickly run through some recommendations. The first set of recommendations are going to be kind of for Malaysian banks if they want to implement this methodology themselves. So the first one is to kind of dive into it, just do it, use PACTA, and also to supplement PACTA with additional alignment methodologies where appropriate. So I noticed in the poll that people are identifying that they want to see other sectors, perhaps the agriculture sector and the real estate sector. So the comment here is that you can complement additional methodologies together to get to a more complete picture. This is what we saw in yesterday's presentation from ING, from Alberto, and how they are using a number of different methodologies together to give them that complete picture as part of their Terra report. So perhaps some lessons can be learned from their approach as well. Secondly, then, our big recommendation is indeed this use of regional benchmarks for both the market and for the scenarios. So with the market benchmark, it's important to understand all of the assets in the area and also to benchmark towards that regional scenario. And I think that was highlighted throughout Daisy's part of the presentation as well. Great, so then the next one is to repeat this analysis. So it's important to do it year on year. And with that, we can start to map how we're progressing towards these climate goals. So we can get started at whichever year we want. We can then benchmark our misalignment or our alignment year on year so that we know how we're proceeding. When you do this, it's important to update your loan book. So we have our new exposures captured or our changes in exposures captured. Also to update the scenarios. So scenario providers are in the past haven't always been consistent as to when they release them. But as this space grows, an increasing pressure on the scientific community to provide these scenarios, we're starting to see these come out more regularly. So we're getting year-to-year scenario comparison, which is a real positive. Also, the asset-based company data, so these underlying assets that we're mapping our exposures to, are also updated yearly. So the free data set from asset resolution will come out in February of this year, and that will be backdated for last year. So you can expect the new data set in February. And this data set will include any changes in the corporate ownership of the companies. So it's possible that companies buy and sell assets, it's possible that companies buy and sell companies. So this will be captured in the change between the 2020 asset-based company data set and the 2021 data set. Furthermore, the production values may change. As financial institutions, if we leverage our influence and if we steer our capital through climate actions, or maybe even through portfolio reallocation, we'll hear a bit more about this later actually, we can start to track how we're actually influencing in the real economy, but also how the real economy itself is just evolving. But the market benchmark will evolve as changes are made in the real economy. Again, this is why it's important to just repeat the exercise year on year to see how things are changing. Right, so then the next recommendation to users is to prioritize sectors that are going to be most material to your loan book. So ideally, we'll be running it across all of the PACTA sectors, but it makes sense to start with the sectors that are most material to your loan book. Each individual bank is different, so it makes sense to focus on your kind of key investment themes and then expand it throughout the other sectors. The final recommendation here is, and again, there's no obligation to do this, but if you would like to, we encourage people to publicly disclose their alignment results. You can do this as part of your sustainability reports, and we also see this in some TCFD reporting. So banks have done this already. Again, you see the ING example yesterday. I won't list them now, but perhaps I'll follow up with a list of other sustainability reports that quote PACTA and use PACTA. And within this, they disclose their alignment. So if you do this, there's a few points that you should consider in your public disclosure. The first one is the coverage of your loan book and how successful we've been to matching it with the asset-based company data. It's important to contextualize this matching success rate or the coverage. The second point is the scenarios used. So there's a multitude of different scenarios. You saw from Daisy at the beginning, some of the ones that we use. All of these scenarios have different levels of ambition, but also different modeling assumptions. It's important to the reader, and when we try to compare between different banks, that we're transparent about the scenarios we've used. Hence, we understand the underlying assumptions and modeling factors within these scenarios. Secondly, it's important, or thirdly, it's important to consider the region. So we shouldn't be disclosing that we're aligned based on a global benchmark if we're, or the other way around, sorry, aligned at a Southeast Asia benchmark, which might be less ambitious, and then claim that we're aligned at a global benchmark. I mean, it probably goes without saying, but it's important to consider the region in our disclosure. Then the fourth factor is a bit more detailed. So this is to do with the financial variable that we're using within our portfolio weighting. This is documented in the methodology document and also will be in the white paper that we issue as well. So I don't want to dive too much into the details of this for now. Then our number we're on now is to disclose the asset-based data provider. So in this case, we've referenced the free data set that you can get from Asset Resolution. But if you want to use your own data, you can. You can supplement this with your own data that you've found from your clients. You may have additional data providers that you want to use as well. The importance here is that we're consistent, and if we're not consistent, that we disclose where there are discrepancies between different data providers. I think this is true of all kind of communications that we make on data as well. And finally, it's important that we disclose the data vintage of the loan book and the asset-based company data. In other words, if we're doing this for all of our exposures drawn down in the year 2020, we should mention this. That's just a simple point at the end. Then I shall move on to recommendations to PACTA as a tool itself. So these recommendations are more to the developers of the methodology, i.e. ourselves on the call now, but also to the NGO society, the NGO group, more broadly speaking, and to scenario providers and potentially policymakers as well. So this is to encourage for more granular and ambitious scenarios. So this is kind of speaking to the scenario providers. We want to see scenarios at the national level. There are some for big nations, but it would be great if we had transition pathways for Malaysia, for example. We also want to see more ambitious scenarios. So we want to see net zero scenarios at the country level as well. It would be great if in 2 or 3 years' time, we could be running PACTA style analysis for transition pathways of Malaysia, which look to achieve the goal of net zero. Currently, we don't have this, but we're starting to see more and more of them. So that's the first recommendation. The second recommendation is to enhance the matching software. So as part of running PACTA for banks, the matching process can be streamlined essentially. So this is from the more technical side, how we can improve it. Then thirdly, we want to see more technology roadmaps for the steel and cement sector, and indeed other sectors. So if you remember, we have these 2 different metrics, the volume trajectory and the technology mix, which are used when we know how the technologies need to evolve. In the automotive sector, we need to go from internal combustion engines to electric vehicles. Power sector, we need to go from coal, fossil fuels to renewables and hydro. We don't know this so well for steel and cement. We know that there are low carbon alternatives for steel. For example, we know that there are electric arc furnaces, which are more efficient than blast furnaces, for example. But these are not, to date, so well documented in scenarios. This is the reason we use that emission intensity metric for the steel and the cement sector. So the recommendation here is to get to a stage where we have these technology roadmaps for steel and cement sectors as well. And in fact, this is coming. There's quite a few interesting industry bodies supported by NGOs as well that are working on this. So we hope to see this come through in the next couple of years. Then the next recommendation here is to include project finance as an asset class. Currently, what we've presented now is purely based on our corporate lending portfolios. As a reminder, we do equities and corporate bonds and funds as part of PACTA for investors. Here we're focusing on PACTA for banks, which is scoped by corporate lending. Project finance will be a critical element to help financing low carbon technologies in the future. And we very much see this in the financing of projects in renewables. This is currently out of scope, but it's a high level priority for us to include a project finance metric as well. Then the inclusion of new sectors. Shipping is high on our list, as has been highlighted as part of these webinars. Real estate and agriculture will also be key to this. So again, we're looking out for this and we're trying to include these sectors as well. Then finally, it's really important that we take just transition considerations into our decision-making and perhaps into our alignment methodologies as well. You'll find in the white paper that we have a dedicated section on this as well, so you can look out for that. And also, as part of this webinar series, I know you have dedicated sessions on the just transition as well. So I will leave it to the experts there to dive into it further. Great, so now we'll move on to recommendations as to what you can do with the back of your PACTA results. So these are potential use cases, and there may be other use cases. As we've said before, PACTA is an open source and iterative methodology, meaning that you can use it how you wish, essentially. You saw an example as to how ING used it yesterday, and you may have your own use cases that you can derive off the back of it. So what we're mentioning here are just some suggestions, and indeed more work needs to be done to bring these use cases to like their full maturity, if you will. So the first one is what we've been the focus of these calls around risk management. PACT can be used as a qualitative level itself to infer risk management. If we're aligned to scenarios, we are less exposed to climate transition risks. If we're misaligned, we are exposed to climate transition risks. That in itself is quite qualitative, but then if we want to quantify these risks, we need to look at additional tools such as climate transition stress tests. This is what Jacob presented yesterday. And this is trying to quantify the financial shocks that might come as a result of climate change. Again, this uses the same bottom-up production-based approach that PACTA does. Then the second broad use case here is target setting. So again, you saw how ING yesterday were using PACTA to set their climate targets. Again, not for all sectors, but in the case of power, automotive, and I believe, it was just those two. Oh, I believe steel and cement as well, actually. Great. And then the third one here is for the development and monitoring of climate actions and strategies. So we'll hear from Suad in a couple of slides' time about how 2DII have been developing a climate impact management system, which can help to document these and to action climate actions. So again, PACTA is not this in itself, but it can feed into this use case. Then the next one is about identifying and engaging with our clients to help steer capital towards these climate goals. So with PACTA, you get your portfolio level results, which is what we showed previously, but you can also get the same set of results for each of your individual clients. Off the back of this, we can understand how they are aligned, which of those clients are driving our portfolio level results, and we can then take these results to our clients to help them to understand their risk and then help them to drive their transition as well. Finally, the use case around reporting and disclosure. This has been used quite a lot in the past in TCFD reports and also in sustainability reporting. I'll try to share some examples of that in our follow-up from this session so that you can start to see how other banks are doing it, and we can work kind of collectively to improve our reporting and disclosure on climate alignment. So with that, I'll move to the next section, which is about what we can do after PACTA. So we're going to give you a little bit of a flavor as to some of the additional work streams that we've been working on at 2DII. So some of our other research and our other tools. The first one will be around this question of impact. So I'll hand over to Suad to explain our evidence for impact program, what we mean by this, and how it can be useful to you as banks as well. Thanks, Suad.
Thank you, George, and thank you actually for having me in this webinar. So I work at 2DI's Evidence for Impact program, and I will actually tell you a bit more about what we do at the E4I program stream as a continuation actually of the PACTA presentation from Daisy and George, and because now actually in this program it's about what to do after a portfolio alignment assessment. So in the next slide, I will do a quick, could you move to next slide, please? I will do just a quick intro on the Evidence for Impact program and give you a bit more context on why the E4I program has been launched. So actually it's needless to mention that the climate target setting are becoming increasingly trendy. There is a huge surge in initiatives that are focused on climate-related strategies, climate-related targets. To name a few, like Net Zero Asset Owner Alliance that already you all know. So what we noticed is actually that these targets, these pledges are usually and often focused on portfolio alignment goals. So these goals, these alignment goals are actually quite relevant for many reasons. And as George mentioned previously, for example, a transition risk perspective from exposure to climate change, from this perspective, it's quite relevant. But actually the extent to which these goals are actually can be used as means to contribute to changes in the real economy, it's still uncertain, let's say. So it's important also to note that some of these initiatives that we've mentioned, request that the signatories commit to reaching their alignment target through impact rather than simple portfolio reallocation. And actually the Net Zero Asset Owner Alliance is requiring this. But the incentive provided by the alignment targets can actually sometimes get in the way of such impact objectives and add to all other barriers and constraints to impactful action implementation. So all that to say, it's actually precisely to tackle this kind of lack of knowledge and on impact, and also to help and assist FIs contribute to impact in the real economy, that this program, Evidence for Impact, has been launched at 2DI. So in the next slide, I will just talk about the main pillars of this program to briefly tell you like what are we working on in this program. So the first pillar is really research to understand what works, what doesn't, based on academic research. So that's the material that we use for our own research. So it's really based on academic research. Then our second pillar that we'll dig a bit more in this presentation is like developing frameworks on for impact strategies. And as George mentioned, the climate impact management system actually that has been developed by 2DI in Evidence for Impact program is part of this pillar. And finally, actually is disseminating all of this research and this framework. So before explaining now what this SIMS, this climate impact management system is, I would like to give like some definitions, some notions that are actually important for our program and for 2DIs to have in mind and to have a clear understanding and definitions of these notions. So in the next slide, we will be discussing the difference between alignment and impact. Well, I mean, alignment, which is actually at the core of most current target setting initiatives, and impact that doesn't have the same definitions everywhere. So it's important for us to have like clear and unified definitions of what is an impact for a financial institution. So actually, what is it? Like what do alignment mean, and what does alignment mean, and what does impact mean? So if we talk about having impact on climate goals, that means causing a reduction in the real world GHG emissions of companies. So here, when we talk about having impact, it's about making changes happen. When we talk about portfolio alignment, we refer to like So we talk about portfolio alignment, it's an exposure logic as mentioned and described by George and DC. So the alignment scoring can be expressed by different ways, like temperature scoring, technology capacity alignment, but in all these cases, like the underlying logic is an exposure-based concept. So now, to align a portfolio, there are two things that can be done. Either reallocation, so this is the exposure logic, or try to actually impact the activities of the companies in the portfolio. So it seems like one solution of becoming aligned with the Paris Agreement goals is trying to have an impact. But most often, when we hear about alignment goals, reallocation is actually what is happening. And mainly that's because it's often much easier to reallocate than directly impacting companies. So in the next slide, we will have a much more clear definition of the impact of financial institution. So now that we agree on having having an impact is about actually a reduction of GHG emission in the real economy, defining an investor or a financial institution impact is quite important. So you can see here like a complete definition of this, and then the one that I gave earlier in the previous slide. So financial institution impact is actually the change in the company impact that is caused by the action or activity of the FI. So two things are quite important here. We need to distinguish between a financial institution impact and the company impact. This is crucial. So the FI impact is actually the share of company impact that has been caused by the FI, which means that the FI cannot just get credit for the whole impact of the companies. This notion of causality between FI impact and the real economy is really crucial. it's quite also important to prove this relation or this causality link. So the FI needs to have caused a change to claim it. It cannot just get credit of changes caused by other factors or other actors. So yeah, this has kind of strong implication for mainly, and also a strong implication in terms of claiming and impact, and also to foster ambitious action. It's important to understand what is it to have an impact from a financial institution perspective. In the next slide, now actually, what can a financial institution do to maximize the impact or its impact potential in the real economy? That's the question. So what type of action could be undertaken? There are various actions that financial institution can implement to have an impact. On the left side of this slide, we have like a list of climate action that we scoped based on various surveys and existing work. So we can name a few examples here. We have divestment that everyone knows. We have some in the same bucket, kind of like exclusion or positive screening, much more exotic actions such as offering like concessional capital, which is like capital at a rate that is below market rate, and the engagement with investee companies, obviously. So now all these actions on green can be done with the aim of having an impact. Now, from a FI perspective, for an individual action, if not all of these actions can actually have the same chance of succeeding. So we do have like a growing body of literature that investigates the impact of all this action. It's quite incomplete, clearly. There are various caveats that I won't dig in here, but we already have some information and we are able to associate to these climate actions some level of evidence. So this level don't tell us actually that if an action will work or not in terms of impact, or how well it will work. It only tells us the level of proof that we have that it works. It's inefficient, that's for sure, but actually it's a good basis if, as an FI, you want to build an evidence-based product or an evidence-based strategy. So if we take an example, again, like for the previous climate actions, and we map this level of evidence, so we see that for individual action, for a financial institution, to maximize the impact potential, the most relevant action to implement will be engaging with the investee company, allocating capital at a concessional rate, or allocating capital at conditional with condition, which means allocation of capital if climate KPIs are met. We also have other actions such as divestment, exclusion, green investment. From individual action of a financial institution, there is less proof that this will work, but that doesn't mean if this is done in a collective way, it cannot have like results. So the conclusion of this is to have, for an FI, to have the highest possible chances that the strategy, the climate strategy, will contribute to climate change mitigation. It's better for an FI to implement as many of green action as possible. It doesn't mean that you as an FI shouldn't do the yellow ones, for example. So especially if you are a large institution with likely like a strong influence on market prices, big leverage, then actually portfolio reallocation are things that are interesting to consider. Or also if you have no other lever for impact, as it can be the case for like companies that are quite unlikely to change if you engage, such as coal companies, for example. But if you want to claim that as an FI that your strategy has an impact as an objective, you still need some form of scientific backing, and you need to do actions that have the potential to deliver direct impact. And again, I mean, I insist, it's important to insist on that, like collective actions whose impact is not and probably cannot be demonstrated, like coordinated screening or exclusion or divestment, should not be discarded on the premise that there is no evidence. FIs simply, in this case, need to be cautious in the way they communicate about it and avoid claiming impact. So now that we defined kind of like a set of climate actions, we can go in the next slide and tell you a bit more on how can these climate action be implemented in what type of process. So we define clearly now the concept of a financial institution impact. We had an overview, as I said, of climate action that would maximize the impact potential of the FI. So yeah, as I was saying, the question is how to operationalize all this. What would be the process to follow for an FI for building an evidence-based climate strategy or a climate product? So that's actually where the climate impact management system developed at 2DIs would help. This framework, the SIMS, is, so as I was saying, basically a framework. It's a process, a list of steps to follow. Its goal actually is to guide the FIs in setting up climate strategy that are made to have impact on climate change mitigation. And this is by drawing like on existing scientific work. So there are various steps that we guide like FIs through that enable them to build like a climate strategy. So the first step will be that the combination of step 1 and 2 that we could see in this graphic. So it's about understanding the current situation of the FI in terms of where is the FI standing in terms of portfolio, and here PACTA could be used to for scenario alignment analysis to also identify the relevant sectors. Then it's important also to do a company assessment to select like the universe of company to target with climate actions, and the company level tools could be used for this step. And also like select the ideal climate action to implement based on the FI constraint also. So first step, as I was saying, is what is the where the FI is standing. So portfolio assessment, company level assessment, selection of climate actions. Now, while this initial step is done, then it's about actually building an action plan and define real world changes that the FI want to trigger with these actions actually on this target list of companies. And here we also have at 2DIs like some handful tools that could assist the FI describe like a truly trackable and impactful climate action plan. Then of course it's about implementing this action plan, checking and tracking the implemented actions to assess their effectiveness. And here it's about using PACTA to reassess the portfolio alignment and the climate performance of the targeted companies, also using climate company level assessment tools. And the final step would be, of course, to disclose and communicate transparently on this result of the implemented actions. And it's an iterative process. It's about continuously revise and improve the climate actions implemented. So this overall process can be applied at the level of the whole institution, can be applied at the branch level or product or portfolio level. So just quickly to conclude, so for an FI, as I was saying, to maximize the impact potential in the real economy in terms of GHG emission reduction, this climate impact management system could help actually with the different steps to follow for an FI to implement a science-based climate strategy. So I will hand it over to George now to tell you a bit more about our other stream at 2DI.
Great, thank you so much for that, Suad, and I hope that helps people understand a bit more about how PACTA can be used in some of these use cases as well. Great, so for our next section, unfortunately, my colleague Anne couldn't be here, so I'm going to quickly run you through her slides. And this is other work stream called 1 in 1,000. So this is focused on long-term risk management. And this is actually where the stress testing piece that you saw yesterday fits into. So this work stream, 1 in 1,000, is the objective of developing evidence, designing tools, and building capacity to help financial institutions, but also supervisors to mitigate and adapt to future challenges. So which risks are included in this? First and foremost, it's these kind of climate risks, but it also extends into ecosystem services, biodiversity loss, and then the associated loss of social cohesion and resilience alluding from these previous factors. So it's a bit broader than just the climate stuff. We're now looking at ecosystems and kind of social factors as well. So why do we then focus on financial markets for this? It's two sides of one coin. So financial institutions can play a crucial role in this, in influencing this. So in the same as what's gone before in terms of impact, we can see that financial institutions can have an impact through their capital and the way they use their capital to influence change in the real economy. And then the flip side of that, from the risk management perspective, climate change and these other risk factors will also have a material impact on the financial markets. So it's the two sides of that coin, and it's the financial institutions that play a really crucial part in this. So who do we target through this work stream? We're looking at supervisors and central banks, but then also the individual financial institutions themselves, the asset owners, asset managers, and banks. And then also we're looking at policymakers in the financial sector. So how do we do this? This work stream is based on 3 assumptions, forming 3 areas of action. So the first kind of assumption is that financial institutions' eyes are closed. They're not open to these long-term risks. So to solve for this, the first area of research is about long-term investing metrics. To this end, we surveyed over 60 financial institutions about what it means to be a long-term investor. The second concept then is that when financial institutions have opened their eyes, once they've understood about these long-term risks, they can't really see. So they don't know how to quantify these risks and kind of what to do about these risks. So this is then, we look to solve this through the second area of research, which is these risk management tools and frameworks. So the first one of those is the stress testing. So if you think like PACTA has shown you where the alignment is, the stress testing tool is then starting to show you what to do with, or show you how to understand how these risks are quantifying to kind of financial risks to you as portfolio managers. Another tool here is an SME database we're building at the moment, and I'll give you a quick introduction to that in a slide's time. Then the third kind of area here is that once financial institutions can see, they don't have the incentive to act. So this is where we're starting to work with policymakers and to provide incentives for financial institutions to act on these above risks. So to that end, we've written a green sentiment index paper, and we've got an upcoming paper comparing COVID and climate change and how we need to start actioning to mitigate around climate change from a policy and incentives point of view. So with that, on the second part about how we develop tools to help the investors or the financial institutions to inform decisions around this, the first thing was the stress testing. So the stress testing was covered yesterday, and you can watch back on the recording if you want to catch up with it. The second part then is this SME, small to medium enterprise database that we're currently creating. This is what we're calling PACTA X, and this is being tested, it's being built in Germany to start off with, but we plan to expand this after this pilot study. So how are we building this database? We're scraping information from SMEs' social media, from their websites, the media, and also from business registries and phone books. From this, we're deriving different bits of information that can inform us on climate risks, sustainability improvements, and on reporting. And that will be made available to financial institutions with an influence on SMEs. So to give an example, this is a German example where we're scraping information from these different sources. which is then being fed into the PACTA X database. I'll give you the second example as well, which is about the geolocation. So the story here is that on the right-hand side, we see that there's a coal mine in Germany, I believe. Yeah, and then we have, and it looks like it's a coal mine that's getting disused or being closed down. And we have a cafe or a restaurant. So the assumption here is that the restaurant will be servicing all the employees of this mine. So as this mine gets shut down, we can understand the transition risk that might impact the associated SME, which lies next to it. So this restaurant may be impacted by kind of transition risks, which might not seem intuitive at first, but we can derive this information from their phone books and from the social media and everything, understand the geolocation, and understand how risks might impact this small business. Again, that then feeds into this bigger data set, which is then made available to financial institutions. Great, that was a very quick introduction to 1-in-1000. We'll leave the contacts for my colleagues that work on this full-time if you have any questions on that at the end. With that, I'll then introduce Constanza, who's a colleague that works on our retail investment program. So I'll hand over to you, Constanza, to introduce the topic. This will be our final little segment before we'll open for Q&A afterwards. Thanks, Constanza.
Thank you, George, and thank you for having me here. Can everybody hear me, I hope?
Yes, we can.
Great. So my name is Constanze Bayer. I'm a senior analyst at 2DII, and I work mainly in the retail investing stream. And my task here will be now to introduce shortly what we as an organization are doing with regards to retail investors and why we think that you should too. I have to say in advance that our findings currently are only in the European context. So we are aiming to broaden these in the future, but currently these are European findings. On my first slide, you can see that retail investors hold a substantial part of assets via their insurances, their pension schemes, or via their personal investments. We, alongside a lot of other researchers, have conducted surveys in the past years about the interest and the willingness of those private investors regarding sustainability. And what we found is that there's a large potential because there is a large share of private investors that are actually interested in sustainable products, not only in the supermarket, but also in their bank account. We found numbers, and these are coherent with other research, of 60 to 70% of retail investors in Europe that are actually interested in sustainable finance products. And while a lot of this interest is about aligning finances with personal values, such as religious views or personal lifestyle choices, there's also quite a number of people that actually want to have impact. And impact here means the same as what Suad earlier said and explained. It really means changing GHG emissions on the ground in the real world, and not something artificial or theoretically. So really, this is about people wanting to change the world with their money. And we found that even those more ambitioned clients are quite a large share of them. And now you could say, like, okay, but is this all cheap talk? It's nice to say this in a survey. And we find that apparently it's not only cheap talk, as you can see on the next slide, please. If we're looking at the left-hand side, you can see growth rates for sustainable finance products in the whole world, which has been growing in the past years. And on the right-hand side, you can see those numbers for Europe, where we have also seen growing markets. So we can see that customers are not only interested, but also actually are buying accordingly their products when they're investing themselves. However, what we've seen in face-to-face interviews and mystery shoppings that we have conducted in Europe, especially in France and Germany so far, we found that despite the evident interest, sustainability was not a topic in the investment advice. If you could show the next slide, please. When customers were asked to evaluate if they have been asked about social and environmental expectations, the majority said, no, we weren't. In the European context, this should change in the future as the legislation is changing here, but still you can see that this is quite a way to go. We found several problems that cause this problem here, and we see them on the side of distributors and manufacturers. Next, please. So first, on the distributor side, we see that, again, advisors are often blind because they don't know how to ask exactly for extra financial topics. So we're really deep into talking about what are financial goals, what is your risk profile, but not so much what is your concern regarding sustainability. And even if they're asking, the questions are often too broad. Here are missing good templates. And then from a manufacturer's side, we see that even if those questions are asked, there's simply not good enough products that can be offered to retail investors who are interested, because a lot of those products that can be offered are one size fits it all. So they're not taking into account that people have diverse interests into ESG topics and not the ESG topic. And what we also see as a reaction on this increasing demand is an overselling of potential impact. This again goes back to what Suad explained earlier. We see a lot of claims of achieving 2 degrees global warming with buying a certain financial product, which is not backed by evidence. And this then yields a potential problem. Next slide, please. So what we then see is really a mismatch and a miscommunication between the supply and the demand side that we can quite clearly see when talking to retail investors. We see a lot of them on the left-hand side that want to have real-world impact, that have diverse interests, that are interested in voting power mechanisms, and that want strict exclusions for certain topics. And we see often, we can't see on the right-hand side, that the demand side can't offer the real world evidence for impact, that there are one size fits all products that are not meeting the demand, that very often voting mechanisms are not in place, and that even an apparently easy topic, as you might think in the first place, as exclusion is unstandardized and therefore is open for a lot of misunderstandings from a client side, which have problems with understanding, for example, certain revenue thresholds or with value chain exclusions that are not very intuitive for a retail investor. What we suggest on the next slide are then what can you do to overcome these issues? So the first thing would be really to actually understand what your clients want. And for this, to choose the correct elicitation format that is the best for your context. This might be surveys, this might be templates, but it might even be alternative methodologies such as investment games. Furthermore, once you elicitated those topics, understand really what is the motivation. Is it about personal values for religious reason, for example? Is it about making an impact? So is it really about coming from this topic? Or is there somebody sitting in front of you who doesn't have any interest in these topics at all? And then to understand which topics are it explicitly. So what we see a lot is that people care about climate change, about child labor, also about health and renewable energies, also about education, but also about corruption issues. Next slide, please. And this goes more to what you can do to offer products accordingly. The first and one of the most important things that is often underrated is to manage your own sustainability, as in PACTA or in climate impact measurement systems. And to be really transparent, what we see is a lot of mistrust that is voiced when we talk to retail investors, because we, especially in Europe, in the context, there have been scandals about greenwashing and about missing evidences that make people reluctant, despite their personal interest in the topic, to choose accordingly the products. And then, and this is, I guess, after having done all this homework, the easiest step to actually match the products according to financial and sustainability preference, both alike. So in order to help with this, 2DII has developed in the past 2 years a platform which is called My Fair Money, which you can see a screenshot from on the next slide, please. And one of the main goals with this platform is to help structure a dialogue between an advisor and the client to talk about sustainability goals connected to financial goals. So we have created a questionnaire that you can use in order to elucidate those the sustainability preferences that your client might have. And this is more used for by the customers themselves to actually look for products or to check the products that they have already bought, which you can see on the next slide. Here we show the offer you can choose from regarding exclusion criteria from the 3 topics of environmental, social topics, and from corporate governance topics. And on the next slide, you can see a more detailed view that we show for currently only European funds, but this can be, of course, transferred also to other markets. And this is also something where we use the PACTA methodology to come up with the Paris score that you can see on the left-hand side in the middle of this slide. What we tried to do here was to make the PACTA methodology and the PACTA results more digestible for somebody who is not a finance professional, but who's just caring about sustainability topics and who's looking at his or her personal finance topics. So we aggregated PACTA results for a given fund and developed this score, which gives an indication whether the companies in a fund are on average aligned with the Paris Agreement or not. This and also exclusion criteria tailored to a specific region or context can be something that is easily adapted to different regional contexts and could be also interesting, I guess, for the Southeast Asian and Malaysian market. To wrap up, the retail investing research is currently far from finished. Future topics will be to continue working more on how to elicitate real versus stated preferences, as we're working a lot with surveys, how to match products that are already existing according to certain preferences that have been stated, and also how our findings that we made currently mostly in Europe are adapted to other regional contexts, as for example, Asia. And we hope to do that in the future. If there are additional questions, please let me know. Thank you.
Great, thank you so much, Constanza, for this, and thank you everyone for all the hosts and panelists as well. Great, thanks so much everyone for attending. So we now have a Q&A session. I see there's already quite a few questions, and please feel free to drop into the Q&A box. If you're having questions with the Q&A, please feel free to put them in the chat, and we can read them out from the chat as well. Alternatively, if you want to message one of the hosts individually, which you should have an option to do, we can ask you to unmute as well. But before we open the floor to the questions, I just want to extend a massive thank you again to the JC3 for hosting us today, to the MSFI for their support, also to WWF Malaysia for their support and as an implementation partner. And then finally to our funders that have enabled this to be possible, which is UK PACT Malaysia. So thank you to everyone for their support there. And also a massive thank you to all of the participants, especially as it's in the afternoon on a Friday. To see such a great turnout is really, really inspiring and great to see. Great, so thanks so much for that. I think we had scheduled to finish the call around now, but we're more than happy to stay online to answer some questions, and apologies for running over slightly. So I think there's a really good question, which I will start with, on the use of PACTA with central banks and with regulators as well. Indeed, this is kind of a third use case of PACTA. Throughout the 2 days, we introduced PACTA for investors and PACTA for banks, which was the focus of today. But there is a third kind of option. This is what we refer to as PACTA COP. When we say COP, we mean coordinated projects. So here we are coordinating the running of alignment metrics or alignment assessments with a group of financial institutions. This can be coordinated through different actors. This could be done through a regulator, a supervisor, could also be done by a central bank on behalf of the financial institutions, or it could be done through like a voluntary agreement between different banks. This has lots of benefits, and we'll start to document these in the white paper as well. To date, we've had several central banks in Europe doing this. I won't list them for confidentiality reasons now. And also several supervisors have run this. Most notably in the stress testing side of things, EIOPA, which is the insurance and pension fund regulator in Europe, has run the the stress testing module. So yeah, just to mention that that is very much a thing, and we do it. When we do this, we do it in a kind of with an agreement between 2DII and the implementation partner, be it a central bank or regulator. So please feel free to reach out to us if this is something of interest as well. Cool, Daisy, do you want to give us a hand with directing some of the questions to the panelists? Thanks.
Yes, actually there is a question for you, Constance. Maybe if we have still some time to answer. So the question says, are there plans within Europe with eco-level operators to adjust or align their criteria for sustainable finance products?
Yeah, so thank you for this question, which is a really good one. I'm not aware that there's actually from a regulator perspective to align those labels, especially if some of them are from a private sector. But what we have seen is really ambitions to at least coordinate better on what is sustainable and what is not sustainable, and what is worthy of being labeled with a certain product, especially among those that are more from a regulator perspective, as for example, the Austrian Eco label and the Nordic Swan label from the Scandinavia.
Great, thanks a lot. We have maybe another question which might be directed to Suad. Are there samples or reported successes so far on climate actions taken by financial institutions to support greenhouse gas emissions reduction in the real economy?
So thanks for the question. So actually today, the journey of climate strategy from financial institution perspective started recently in terms of building a climate strategy with climate action that have the highest level of evidence of effectiveness. This scientific research appeared kind of 2 years ago about what are the climate action that would have the most the highest level of evidence of effectiveness if implemented. We are currently now in the process of collecting data because this started, and we need to, it's still in kind of a progress to check if this is working. And mainly it won't be about measuring quantitatively GHG emission reduction, because this, as I was saying in the presentation, this causality link between an FI impact and GHG emission reduction is hard to link, has to prove. There is the company impact in between, but the most important for an FI is to have like a theory of change, to have the outcomes that this FI would like to achieve, and what are the steps and the climate action that are the most impactful that could be implemented to achieve this outcome. So I hope this answered the question, but yeah, currently that's the status.
Perfect, thanks a lot. I think there is only one remaining question, and maybe, I don't know, George, if you want to say some few words, whether like Malaysian entities are or will be required to use these tools. From my point of view, I will say this is just one of the many tools that are available now for financial institutions to measure alignment to climate scenarios. Whether this will be required or not for Malaysian financial institutions will depend, of course, on regulators and supervisors. But our aim was just to show you and explain one of the many tools that exist in the market. But George, I don't know if you want to say some few words, given this is the last question.
Yeah, thanks for that, Daisy. So indeed, there's no obligation from our side to do this. As I mentioned, this is a free tool. It's an open source tool. So all users are encouraged and welcome to go do this themselves. But also they can, we can look to walk towards a coordinated project as I described before. Something that's really good about these coordinated projects is we can create peer comparisons. So we do kind of like a meta level analysis, which gives us an overview as to the alignment of the Malaysia financial sector as a whole based on this methodology. We've got big use case of this in Switzerland and actually across Europe. We also did this with the DFS, which is the it's the insurance supervisor in New York. And it enabled us to get a meta-analysis of the alignment of that sector, that financial sector. And then each individual participants get their individual results, which are private to them. Within those private results, we can also make a peer comparison. So we can see how you benchmark and you line up against against your peers, essentially. So we hope that that's quite a useful thing to do. We're very open to discussions around this as well. I see that Fatin would like to answer this as well, so I hand the floor to you on this.
Yeah. Oh my gosh, I was just no, please go ahead. I think Leeton has another question for you.
Sure. Yeah, so I think this question about bottom up versus kind of top down, from the alignment perspective, so the PACTA one, we personally believe that this bottom up approach is a crucial one, as this really ties you to the economic outputs in the real economy. This is also what you can influence, and that introduces notion of impact as well, because we are tying the actions taken in the real economy to your investment or your lending decisions. So that's what's like allowed through this bottom-up approach. Also, another benefit of this bottom-up approach or this PACTA approach is we're using kind of tangible data points, these production values, which are well known, they're well audited, and they're consistent. This data set that we have covers all assets in the real economy. Of course, there'll be I'm not saying it's every single one, there'll be a caveat to that, but for the sake of the argument, just take it as all assets. We know how their technologies and the productions from those technologies are evolving in the future. This is well audited, has been for years. So that is an actionable lever that we can influence. This might be different to a kind of some top-down approaches in the alignment space, which look at kind of carbon accounting. When you're looking at this, there might be inconsistencies between the different ways in which companies are reporting on their carbon. It's also true that not all companies do account their carbon or account for it. So you have comparability and also coverage issues there. This bottom-up one, and furthermore, this is based on a backward-looking assessment. So it's historic carbon data. This kind of PACTA approach is forward-looking, which can help you inform decisions and steer in the future. That's kind of from the alignment perspective. And again, that doesn't mean to say one's better than the other. It's just a more complete picture. Then from a climate stress testing perspective, you can think of the top-down approach as being more of a traditional approach to stress testing, macroeconomic scenarios being from the top down. This is quite different to what's been presented as this climate transition stress test that was presented to you yesterday. I think the NGFS, the Network for Greening the Financial System, has done a lot of amazing efforts on the more top-down side of things. And again, this is an additional tool in your arsenal to tackle climate change. So it's not to say that top down is better than bottom up, or bottom up is better than top down. It's that these are additional tools that we can use together to better understand our climate transition risk. I hope that was helps to answer that question. And if there are no others, I will hand over to Fatin quickly. Thanks.
Yes, thank you very much to George and all the speakers from TDII and to JC3 for hosting this training session, and to all the participants for your attention and participation. We hope that yesterday's and today's training session have been very useful for everyone. So some final words before we end. Aside from this webinar, there will be another training session hosted by JC3 on the 19th of January, focusing on the implementation and application of CCPT, which stands for Climate Change Principle-Based Taxonomy. So if you are interested in the topic, we highly encourage you to register for the workshop. Secondly, just as WWF Malaysia and TDII have collaborated to introduce PACTA to the banks in Malaysia, this year we'll be continuing and expanding our efforts to this capital market players enabled by UK PACT, a program funded by the UK government. We have installed more capacity building initiatives on portfolio alignment and climate scenario analysis, so do be on the lookout for that. And lastly, as soon as you exit this webinar, you'll be directed to a survey page where your response and feedback will be very much appreciated. So with that, we have come to an end to our training session. Thank you, everyone, and I wish you a good day.